All right, I think we got this. This is going to be recorded now, so all right, that means uh, Grace, you better watch your mouth. So no swearing. All right, I'm going to share my screen, and you should have the exercises in front of you. This is just chapter 20 today. We have just a few exercises, so we'll look at these and you ask me questions if you have any. So the first one is on number 1, and it's on page, I got to get there yet. It is on page 1031. So what we're doing here is we're classifying costs. It's a managerial concept. If it's fixed, is it variable? And then sometimes it's what we call mixed. So it's a little bit of both. So we'll go through this list here. Oil used in manufacturing equipment, because of all different things, you could use more or less. That's going to be a variable cost. It's not just fixed. Plastic, again, are we building 5 units or are we building 500? So that would be also variable. Property taxes is one of those things that they tell you this is what it is. It doesn't matter if your volume is 1 unit or 1,000,000 units, this is exactly what you pay. So that's fixed. The salaries are fixed. Labor, if it's hourly, of course, then it's variable. Packaging, again, depending on who we build, variable. The cleaning costs there, they just tell you it's $6,000 a month, so it's fixed. Metal's no different than packaging, so it's variable. Number 9, this is a new one. The rent is $10,000 per month plus how much you use. So if you are using 1,500 square feet or 5,000 square feet, you're going to pay the base of 10, and then as you use more or use less, you will pay differently on that square footage price. So that's a variable and a fixed. So we call mixed costs. Number 10, insurance. Again, it's that $3,600 a month plus this penny for every dollar of property over $1.2 million. Again, that's mixed. Straight line depreciation. We're going to use that same number every month. Fixed. Hourly wages, variable. Electricity costs, variable. Computer chip and the pension cost of $1 per employee hour on the job, again, all of those are variable costs. Pretty straightforward. Anybody have questions on number 1? Anybody? All right, number 2, it asks you to identify what's going on in these graphs, and this is, or excuse me, identify A through E to which is the best graph that explains it. So these are actually very good. Total direct material costs, letter A. So we're talking about total direct materials. The best graph there would be graph 3, because if we're building 1 unit, it'll be at a certain point, but if we go and build even more units, that line is going to go further to the right, but upward. So that graph will go up the more that we produce, and so in total, that number will go up. Now, letter B, electricity costs are $1,000 per month plus that 10 cent. So that would be a great example of the one right next to it, graph 4. So no matter what you do, you're going to pay $1,000 per month. So that line starts up. That green line is going to start higher at the base, and then it'll go from there. So it doesn't start at 0. It'll be up at 1,000, and then from there it could go up. Letter C, per unit straight line. Per unit straight line depreciation on factory equipment. This one usually tricks people up, and it's graph 1. So let's explain how this works. Per unit. So if our straight line depreciation is $5,000 a month, if we only produce 1 unit, that per unit cost is going to be extremely high because we're going to allocate all of that cost to one unit. And that's why you see in graph one, it's way up there at the top end where we'd only produce one unit. But as we produce more units, we will spread that cost over more units. So even though it's fixed, straight line is fixed, it's 5,000 a month no matter if we do 1 unit or 5,000 units. But when you're looking at a per unit cost, then we actually use graph one, because if there's only 1 unit, you're going to get all 5 grand. But as we produce more, we can spread that out over more. Letter D, the salary. So letter D is salary. And if we look at that, I would say that's graph 2. Doesn't matter how many we produce. It's 20,000 per month all the way across. And then letter E, this is the other one that throws people for a loop. Letter E, per unit direct labor. This one always throws everybody for a loop. C and E, and it's graph 2. We just got done saying direct labor is a variable cost, so you would think that line would move. That's true. However, let's think about it this way. If you're paid 20 bucks an hour, that $20 per hour, that's the per unit, that's fixed. But when we look at it in total, did you work 1 hour, 5 hours, or 10 hours? Then in total, that number changes. But per unit, you're still paid 20 bucks an hour. We're not talking about overtime. But for the first 40 hours, that per unit, it's always 20 bucks. But when you work 1 hour or you work 10 hours, in total, it will change. So we got to make sure we know what we're looking at. Is it total or per unit? And we'll look at that again here in a little bit more. Any questions on number 2? If there are none, then let's look at number 3. And it just says here, for a major university, match each of the following table with the activity base that, what drives these costs, what is the most appropriate. So number 1, financial aid, the financial aid office. Financial aid office salaries, what drives those, the financial aid office? And in this case, I would say letter financial aid office salaries, I would say the number of financial aid applications, letter E. Letter E. Number 2, office supplies. Office supplies. In this case, it's the total number of students is probably the best driver. Instructor supplies, or excuse me, instructor salaries. I believe it would have nothing to do with enrollment. It quite honestly doesn't even have anything to do with students. You think it might, but it would probably be more to how many credit hours, right? Because if one student only takes 1 class, that's only 3 credits. But if one student took 15 credits, that's what's going to drive how many instructors we're going to need. Number 4, housing personnel wages. Letter F, number of students living on campus. Number 5, employee wages for maintaining student records. Student records. Letter D, the number of enrolled students and alumni. And then lastly, number 6, the admissions office salaries. What drives the admissions office? Letter A, how many enrollment applications? Okay. Questions on number 3. Number 4, from the following list of activity bases for an automobile dealership, select the base that would be the most appropriate for each of these costs. Number 1, preparation costs, cleaning, oil, gasoline for each car received. So let's look at that one first. The preparation costs. So number of cars sold, no. Dollar amount of cars, no. Number of cars ordered, number of cars on hand, number of cars received, I think would be the best one. Preparation, how many did we receive is how many we prepare. Salesperson's commission of 5% of sales price for each car. Number 2, I think, number of cars sold looks good, except for letter F. It says dollar amount of cars sold is what we'll take at times the 5%. Letter F. And then number 3, administrative costs for ordering, administrative costs. And I think the best one there is the number of cars ordered, letter C. Number 5, Intuit develops and sells software products for the personal finance market, including popular titles such as QuickBooks. Classify each of the following costs and expenses for this company as either variable or fixed. Okay, variable or fixed. So letter A, packaging costs. Of course, we've said that's variable. Sales commissions, variable. Property taxes, fixed. Shipping, variable. Straight line, fixed. Here again, salary, fixed. G, salary, fixed. H, salaries, fixed. Wages, that's hourly, variable. Costs of providing online support, variable. And user guides, variable. Any questions on 4 or 5? Okay. Please let me know if you do. Number 6 is a good one in that it really details out for us the difference between variable and fixed, and more importantly, variable cost per unit and fixed cost per unit. That's what usually throws people. So let's look at what we got there. Total toys produced 40,000 units. Total costs, variable, fixed, and total 1,320,000. So the very first thing you could say is that 600,000 of fixed. Again, it doesn't matter if we're doing 40,000, 80,000, or 120,000. You can put that 600 all the way across. Okay, that's fixed. Now, variable cost per unit. Variable cost per unit is 720,000. So if we're trying to calculate the cost per unit, the variable cost per unit, letter A, we take the 720,000 units, variable costs, divided by the 40,000 units. So that's 18 bucks. Now what you got to see here is that if we look at now, let's move over to the second column, 1,440,000 divided by 80,000, that's also 18 bucks per unit. So that goes back to my example of you're getting paid 20 bucks an hour. So though in total that will change, and that's where we see how it went from 720,000 to 1,440,000 to 2,160,000. In total it will change, but per unit it stays the same. So you see how the 18 bucks, you can put that all the way across for letter A, G, and M. Okay. The fixed cost per unit. Well, we took our 600,000, this is for letter B, divided by the 40,000, and that gets you 15 bucks per unit. Now, this is where people mix up and they say, well, then that 15 should be all the way across. No, this goes back to that example of if we had straight line depreciation of 5,000 a month, and now we do 1 unit, or are we doing 10,000 units, that fixed cost gets spread over more units. Or this salary, the president's salary, if we can allocate it over 10 units or we can allocate it over 10,000 units, it makes a big difference. So then we can take the next column over, the 1,440,000 divided by 80,000 gets you 750. We doubled our production. And then we move over and we added another 40,000 units to a total of 120. So then you take the the 600,000 divided by 120,000 and we get 5 bucks per unit. So you see how things change as we go across. 18 bucks, the variable cost per unit stays flat. That's the same because that's the per unit. So variable costs per unit stays the same. fixed cost per unit will change. Say that again. First, total variable costs, keyword there is total, will change with production. The total fixed costs per looking at production stays the same. But when we look at it per unit, the variable cost per unit stays the same, 18 bucks all the way across. But the fixed cost per unit, that will change because the more we produce, the more we could spread that cost over. And then F and I, or C, I, and O, those are just totals. We don't spend any time looking at that. Anybody have questions on number 6? This problem really has a lot to do with that, same with that graphs, making sure we understand the difference between the total costs versus the per unit costs. Okay. Number 7, you basically had to look at the reading, and it was a high-low method, and it reads here, Ziegler has decided to use a high-low method to estimate the total cost and the fixed and variable cost components of the total cost. So then they give you this data, and it says determine the variable cost per unit and the total fixed cost. Okay. So what they're trying to do here is, out of those total costs, we have all of that. What we should be able to do is isolate what is the fixed cost. If we can pull out the fixed costs, we know what the variable costs are. So in this problem, what you do is it's high-low, it's the difference in total and the difference in the unit. So first, for the total cost, you take the high, you look at the column and you see which is the highest number. It's 32,120. So you see that right here, 32,120 less the lowest number. In that case, it's 25,100,000. And then the high and the low again for the units. Well, the high was 120, the low was 80. So what we got there is a difference of the numerator being 7,020,000, the denominator is 40,000 units. That comes out to 175.50 per unit. All right, per unit. So that is the variable cost per unit. We can calculate what is the variable cost per unit. So it says here the fixed cost may be determined by subtracting the estimated total variable costs from the total cost, right? So now we will get to the fixed cost. So the variable cost per unit we just said was 175.50. We're going to see if this works. 175.50. And let's look at the highest level. Well, we set this equation up. We set the equation up this way, in that the highest, 32,120,000, equals 175.50. That's the variable cost times the number of units plus our fixed. So total cost equals variable cost plus fixed cost. Total cost equals variable plus fixed. Well, now we know it's 32.1 equals 21,060,000 plus fixed costs. You solve for the fixed costs and you get 11,060,000. 11,060,000. You can also do it for the lowest. Make sure this works. The lowest number there, 25,001,000. Here's our variable costs calculation, 175.50 times the number of units, 80 plus fixed. Again, solving for fixed, we're going to get the same number again, 11,060,000. So it just shows no matter what the volume changes, the base is always going to have 11,060,000. There's always fixed costs of 11,060,000, and as we produce more, the total cost will go up. And letter B, it just says what's going to be our total if it's 115. Well, we don't have to make this difficult. It's 115,000 units. We know what the variable cost is right there. We have calculated 2 times what the fixed costs are, 11,060,000. So our total cost at this volume, 31,242,000. 31,242,000. And as strange as this may sound or as goofy, we always pick on Little Caesars on the corner there, right? They know what their fixed costs are before they sell one pizza. So everybody knows, all of these companies know today, before we even open our doors for business, every day we know what our fixed cost is. And then how many do we need to sell in order to cover not only those variable costs that we're selling, but more importantly, those fixed costs. Because if we don't sell the pizza, we don't need to worry about the variable costs. Because if the pizza is being sold for $5 and the variable cost is 50 cents, we know that we won't incur that variable cost unless we have the sell of $5. But it's the fixed cost that we have to know how many of those pizzas, because what is the profit on that pizza? Well, if it's a $5 pizza and it's got 50 cents worth of variable costs, we're looking at $4.50. So in that case, we're making $4.50 on every pizza. How many pizzas do we have to sell in order to cover this, in this case here, $11 million number? Okay, any questions on number 7? Which really gets us to this contribution margin, number 9. That's what we're really looking at. What do we have to get to in order to break even? So number 9, Young budgets sales of 112 million, fixed costs of 25 million, and variable costs of 66.6 million. What is a contribution margin ratio? Well, what we're looking at here is sales of 112.9 million, variable cost 66.6 million, is a contribution margin of 46.3 million. So what is the contribution margin? This is something you have to know. You can write it down. Sales minus variable costs is your contribution margin. That contribution margin is what pays for everything else. Variable costs will not happen unless you've got the sales. So sales less those variable costs is what we would call contribution margin, and that contribution is what covers all of our other costs, fixed costs. What's the ratio? Well, it's just simply taking this number right here, 46 million, and divided by 112.9 million. So what it says, 41%, for every dollar we sell up here, every dollar we're selling, we are making 41 cents. That 41 cents is what will cover everything else. Okay? So letter B, it just reads, if the contribution margin was 40%, sales were 34.8, fixed costs were 1.5, what's our operating income? Well, we can do this real fast. If sales is 34.8, we can take it times our contribution ratio, 40 cents, 40%. That means we've got 13.9 million. All of our fixed costs that are going to get covered by the contribution margin is 1.5. That leaves us with 12,420,000 operating income. So as long as, they got to give you one or the other. They got to either give you the variable cost number or they got to give you the contribution margin ratio. So in this case, what you can say is, sure, this is the contribution margin ratio, or you could say, what's variable costs? You take this number times 60%. 60% would give you the variable cost number. So you could do sales minus the variable costs equals then our contribution margin, less those fixed equals our operating income. Any questions on letter B? Number 11, and this is where it really gets us to where we're leading up to and why we're figuring this all out, is break even. So back to Little Caesars. How many pizzas do we have to sell where we're making $4.50 per pizza that will cover all of our costs, and that's it? We just break even. So in this case, it says here for the current year, Costco Grove Company expects fixed costs of $27.6 million, a variable unit cost of $805, and a unit selling price of $1,150,000. Unit variable cost. That's fixed, right? Unit variable cost. It's like our hourly. It's $805. Okay. Letter A, compute the anticipated break even. How do you calculate break even? This is a ratio you have to know. Fixed costs divided by unit contribution margin. So what is that? Well, we know the fixed costs are $27.6 million. The unit contribution margin, now what we're doing is we're trying to calculate what is our contribution margin for every unit we sell. In our Little Caesars example, it would be $4.50. In this case, what's our selling price? $1,150, or our $5 per pizza, less our variable costs, $805, or in our case, 50 cents per pizza. That is the unit contribution margin. Not looking at it on total, but by unit. So in this case, how many units do we have to sell in order to just break even? 80,000 units. We have to sell 80,000 units just to crack the 27.6 million. We're not making anything. Our net income would then be zero. And then letter B, it just says, what if we want to realize, we want to get down to 5.1 million in income. We don't want to just break even and have zero. We want to know how many pizzas do we have to sell in order to attain X amount of net income. Well, then all you do is you have to increase that hurdle. Right now, our hurdle is 27.6 million. We got to make that hurdle a little higher. We got to make it another 5.175 higher. So then you just increase the numerator, 27.6 plus 5.175 divided by still the unit contribution margin that we calculated in letter A. In this case, of course, it has to be more units. We got to sell 15,000 more units to attain an operating income of $5,175,000. 15,000 more units. All right, that takes care of number 11. Any questions on 11? Grace, any questions? All right. Number 13. Currently, the unit selling price of a product is $7,520. The unit is $4,400. Total fixed, $23.4. A proposal is being evaluated to increase the unit selling price to $8,000. So going from $7,520 to $8,000. So letter A, it says compute the current. All right, well, currently the total fixed, they told us, was $23.4 million. And then we got to calculate the unit contribution margin. Well, 7,520 less than 4,400, 7,500 units, no big deal. Well, if their proposal is to increase the cost or the selling price of 7,520 to 8,000, of course, we're making more sales. The variable costs are still staying the same. Of course, we should have to sell less units, right? So in this case, everything else stays the same except for the selling price. We could sell 1,000 less units and still make the same money. All right, I did not have you worry about this for today, but let's look at number 19. It just says break even, the break even chart. And identifying this area. Well, let's look at this here. So this point right here, letter A, that's where it says here, we're breaking even. So that's where the costs, all the costs hit all of the profit. Right there, we make nothing. We sell less than that, we're in the loss area. We sell more than at the break even point, of course, we're gonna start making more dollars. Letter B, is this area right in here. Of course, that we said is the loss area. Just likewise, letter E, this is the profit area, right? Letter C is this total fixed cost line. Letter C is the total fixed cost line. Letter D is, where is letter? No, I'm probably, yeah, letter D. Letter D is, letter C says total fixed costs. So that would be, if it would be like right here in your book, this graph here is slightly different. But letter C, that's where we would start with fixed costs, and it starts there. So it would say, okay, at the no matter how many units we sell, we're going to be right at $400,000 worth of costs. And then as we continue along, it would also say, well, that's the total fixed cost. And I guess we can use this line here. If we produce no units, or we have produced no units no matter what, there is no, and I guess in this case, no fixed cost. It doesn't make sense to me. Fixed cost should always be up here somewhere, not right here. So we would have to have something start up here, fixed cost, no matter if we do 1 unit or we do no units or we do 1,000,000 units. You're going to have $400,000 worth of cost. But then the line would increase as we produce more. Our fixed costs in total stay the same. Our total fixed costs stay the same. But as we produce more, our total costs will increase. And that's letter D. So our total fixed costs would be like right at one of these points. And it just stays there. But as we produce more units in total, that would be fixed and variable, then that line will go up. Okay, so total fixed is going to be somewhere along on this line. It doesn't matter if we do 1 unit or no units or 1,000,000 units. Fixed in total stays the same in total. But as we produce more units, the total cost, variable and fixed, will increase. And then letter F is, this is the sales line. This is the sales line. As we produce more, we're going to have more in our sales. So starting here, going up. That takes care of number 19. So on Monday, all I would ask is that if you could review just problems 1A and 2A. That's it. 1A and 2A, and all we're doing there is identifying costs again. 1A should take you about 3 minutes. Identifying, is it a variable, fixed, or mixed? And then 2A is where we look at it from a financial statement perspective, where we're looking at it and calculating operating income. So that's what we've got going on for Monday. Anybody have any questions for me for what we did today versus what we got going on Monday? Hank, any questions? All right, one more time. Are you looking at this right here? Okay. Okay. Yeah, no. So the fixed cost is total fixed, only fixed. So if they tell you, depreciation is $60,000 a year, and the president's salary is $100,000 a year, and those are our only fixed. So we got a total of $160,000 of fixed costs. Then the contribution margin, the unit contribution margin, is the selling price of the pizza is $5. The variable costs into that pizza is 50 cents. So every pizza we make, the unit contribution margin is $4.50. By taking those total fixed costs, if we sell no pizzas, we're going to lose $160,000 a year, right? We will lose $160,000 a year if we sell nothing. Here's the question: if we sell 1 pizza, one pizza, how much will we make? Or how much will we still be behind? Well, you would say it's 160,000 less $4.50 because our fixed costs are going to be 160,000. If we only sell one pizza, we only make $4.50 on that one pizza. So our operating income would be the net of our full cost of 160,000 less the $4.50 that we made on that one pizza. Does that help? Am I making that clearer, or is it getting muddier? Okay. So, and that's the truth. Every retail shop up and down 41st Street or Minnesota, they all know they certainly know what their fixed costs are. They know every day before they open up their door, they've got X amount of fixed costs, and that's their rent or their salaries. So they know before they open up the door, this is the nut that we need to crack in order for us to make anything. And if we don't get past our fixed costs, we make nothing. So in this time, in a real serious way, this whole Corona thing is going to be, very detrimental to the economy. We all know that. There's nothing shocking about that. And who's getting hit the hardest? Well, anything that has areas where there's, where people gather, and they've shut them down. So you're talking the bars, the restaurants, they don't want you can't go in. So what do they try to do to help cover some of those fixed costs? Because regardless, if they don't sell one burger, they're going to still have the real estate taxes. They're still going to have the insurance on the building. They still have probably not the servers' salaries. Those are variable costs, but they still have, more than likely, if the cook, the chef is a salaried person, that cost is not going away. So they've got a bunch of fixed costs that sit there that they're incurring, and there is no contribution margin going against some of those fixed costs. So what are these places trying to do? Come in and at least pick up, the pickup or delivery. So that's what we're going through right now, is these places are trying to do what they can in order just to try to cover some of those fixed costs. Another example I think is real, very real, is some of you are from Sioux Falls, many of you are not, but if you know or have seen the big, huge, it was Sioux Falls' largest construction project in the history of Sioux Falls, was the new Avera Hospital built on the corner of 85th and Louise, that Avera Specialty Hospital. Gigantic project. I think I was told, I'm on that board, that all the glass in that building it covers basically, I wanted to say, 2.5 acres of glass is on that building. Anyway, but that specialty hospital is I shouldn't say all, 90% is elective procedures. So unless it's an emergent need, the emergent needs all go to the main campus, but those elective procedures, so what's in there? Orthopedics, your hip is shot, that's usually not an emergent procedure. They can schedule that at a different time, or your knee has to get replaced, or whatever. So all of those type of specialists are sitting in that building. And as a mandate, both Avera and Sanford have said all non-emergent procedures stop. None of that happens. And the reason is we got to make sure that we have enough, medical supplies for those that are critical and are emergent. So they don't want any non-emergent procedures performed. Well, that building, nothing is getting generated. There's no orthopedic that's generating revenue, and so that all of those fixed costs, you still have got the orthopedic surgeon still getting paid. We have a friend that works out there, and they have asked those departments, OI or the not the group OI, but the orthopedic group, to take their PTO now, take their vacations now, which really is no fun. But they're saying, hey, we need to have these costs somehow managed. We cannot have these people sitting in the hospital doing nothing, and then when everything does turn out great in August, then they start using their PTO or whatnot. So they're having a lot of these nurses, the physical therapists, and some of the physicians to take their PTO now, because that fixed cost is going to happen. Well, let's take it then when we're also not producing any revenue. So anyway, that's more than what you wanted to hear. But this whole fixed costs and contribution margin is really applicable for right now. Anybody else have any other questions for today? And we'll call it a day. Okay. So here's someone gave me this idea. I thought this is a good one. So for extra credit, this is the simplest extra credit that all you have to do. On Monday, you show me your favorite USF attire. You wear your favorite USF sweatshirt or hat, whatever, and then you'll get extra credit for that. So that's simple. That's pretty easy. So it's either extra credit or we'll remove the first test. I forget what we thought we should do, but it's probably just kidding. Anyway, that's it for today, folks. If you need anything, give me a holler, shoot me an email, give me a call, let me know. Otherwise, I will talk to you Monday. Have a nice weekend, everyone.